Okay, so today we're going to attempt, and I say attempt because we're all still learning about the COBRA portion of the American Rescue Plan Act. We're going to try to decipher it a little bit more today and hopefully answer your questions. It's called, well, we're calling it ARPA-ERA Cobra Subsidy Premium Assistance. Essentially, the new plan has provided some premium relief for people who do enroll in COBRA during a certain time period. And then you all as the employer can realize a tax credit for that premium. So it's ultimately a good thing if you have people who qualify, and that's sort of where some of our gray areas are. And as always, as you know, we will admit to you all when we don't know the answer and that we're still awaiting guidance. So bear with us. And then after the first section here, we will be dipping back into some slides about the employee retention tax credit, or the ERTC. We have a quick reminder about the extended PPP loan deadline. And then at the back half, which we probably won't have time to get to, I've just included my FFCRA paid leave slides, just going over the new paid leave provisions that ARPA also laid out. So if we don't get to all of this today live, we will have this posted on our website by close of business today, and you can download it. And some of it will be redundant because you might have seen it before, but it's always good to have. So that said, as you all know, we'll take questions in the Q&A section of your screen. Please avoid the chat. The Q&A allows us to record those questions after the fact, and we'll do our very best to answer them. And if we don't know the answer, we'll try to find it as best we can. With me today, I have Tracy Clark, Kevin Wilson. My name is Leslie Bruno, and we have a very special guest. This is her first time on Dominion Payroll webinar. Tara Rothrock is here. Hi, Tara.
Hello, I'm glad to be here.
So Tara is one of our colleagues at Dominion Payroll, and she is the director of our Benefits Administration Department. I don't know your exact title, Tara.
Director of Benefits Administration. You got it.
Yay, I just go to you with all my benefits questions. So Tara and I have been taking a look at this provision in ARPA over the last week or so and trying to decipher it. And so I asked her to come on today and provide some backup and hopefully be able to answer some questions. So thank you, Tara, for taking the time. I know you're very busy.
Yeah. No, thank you for having me.
All right, so let's jump in. First of all, what is COBRA? Real quick, I just thought I would level set everyone's knowledge about COBRA. It's continuation coverage provided by certain group health plans for participants and beneficiaries. Basically, under COBRA, an individual who was covered by a group health plan on the day before the occurrence of a qualifying event, such as a termination or a reduction in hours that causes loss of coverage under their plan, they can elect to have COBRA continuation coverage after that event. They are referred to as qualified beneficiaries. And under COBRA, which is a federal law, group health plans must provide covered employees and their families with certain notices explaining their COBRA rights. So I think you guys are all familiar with this, but essentially in practice, if someone loses their job due to a layoff or reduction in hours and they no longer qualify to participate in the company plan, they can still participate, but they'll pay their premiums 100%. And Tara, is there anything else that we should add? It's sort of this sort of foundational.
Yeah, I mean, I think that really covers it. You know, it's for both the employees, and then if you had any dependents, children or a spouse or anything like that, that was covered as well. On that last day, they would also be eligible, for the COBRA coverage as well. So.
And typically, I think, and I know this, that their states have some states have their own mini COBRA plans, but I believe the general period of coverage is 18 months, like that's a maximum that someone could.
Yeah, usually you have like 30 days after the termination to, get the employee that COBRA paperwork. And then after that, or sorry, it's 30 days that the employee has to, I think, enroll in it. Sorry about that. 30 days the employee has to enroll. And then after that, they can be covered for 18 months. So.
Right. And so the thing that the two-part benefit of what the American Rescue Plan is providing here is, number one, those Cobra premiums are often very expensive because the employee is paying for all of it. So what the ARP is doing is saying, hey, employees who qualify, you don't have to pay the premium. And then the employer, you guys get a tax credit. So let's dive into what this means. Okay, Section 9501 of the ARP provides for Cobra premium assistance to help, quote, assistance eligible individuals, more on this in a minute, continue their health benefits. The premium assistance is also available for continuation coverage under certain state laws. Assistance eligible individuals are not required to pay their Cobra continuation coverage premiums. This applies to periods of health coverage on or after April 1st, 2021 through September 30th, 2021. The employer or the plan to whom Cobra premiums are payable is entitled to a tax credit for the amount of the premium assistance. So it's sort of a twofold benefit. If someone is on Cobra, it's our understanding that if they were on Cobra before April 1st of this year, they don't get any benefit for that time frame, but between April 1st and September 30th, they would. So we're waiting additional guidance on that. And like we mentioned before, different states may have different coverage laws. So we don't have a state-by-state guide here, but we understand that there are different states that may have different laws that sort of layer on top of this. So hopefully if you have a chance to maybe consult an attorney or a benefits administrator, if you have one, they'll be able to tell you what applies in your state. Okay, questions and answers for the most part, I say, because like I said, we still have some gray areas where we're going to attempt to make those a little bit more into focus. To which plans does the premium assistance apply? Premium assistance apply to all group health plans sponsored by private sector employers or employee organizations, such as unions, subject to the Cobra rules under the Employee Retirement Income Security Act of 1974, otherwise known as ERISA. They also apply to plans sponsored by state or local governments, subject to the continuation provisions under the Public Health Service Act. Premium assistance is also available for group health insurance required under state mini Cobra laws. So I think that's pretty much applies to almost everybody, right, Tara?
Yes, I think there might be, again, like you mentioned before, a little bit of different state by state, and I know we're still waiting on a lot of how is that going to work and everything to come down. But yes, I think it will cover everybody in some type of capacity.
Okay, who is eligible to receive the Cobra premium assistance? So that assistance eligible individual, or the AEI, is one who loses coverage due to an involuntary termination or reduction in hours, and who would otherwise be eligible during the time frame between April 1st, 2021 and September 30th, 2021, hereafter referred to as the period of coverage, including individuals who lose coverage during the period of coverage due to an involuntary termination of employment or because of a reduction of hours. So it could be somebody who lost their job 6 months ago and is still participating in Cobra, or somebody who loses their job during that April 1st to September 30th time frame and qualifies for Cobra. Individuals who lost coverage and did not elect Cobra but would otherwise have been eligible for the premium subsidy during a period of coverage. So this is a gray area for me. And I don't know, Tara, if you have any insight on this, but if I'm reading this correctly, this is saying that if I lost my job 3 months ago and did not elect Cobra, but otherwise I would have been eligible for Cobra, then now I can elect Cobra and get this premium subsidy.
Yeah, that's the way that when I read through it, and again, we work with a partner called ISOP Benefit Services, and in talking to them, we do feel like that's probably the case. As you mentioned in one of the earlier slides, Cobra is overall, it's very expensive. If you sign up for Cobra, and you're paying that full premium and there's no employer, contribution helping you out. Somebody might have decided then, hey, I just can't do this. Like, I can't sign up for Cobra now. But now that there is this premium assistance, I think that's one of the biggest kind of points of this legislation, is that it will, that you can go back and now you can sign up, and it'll be affordable, obviously very affordable to those participants. So yes, I would agree that that's the way that I think we're all understanding it right now.
Okay, so they would get back on the employer's plan, but they would not be charged a premium, and the employer would get a tax credit.
Yeah, so the employer would sign them up. They pay the entire premium, the employer would, and then they are basically kind of reimbursed for that through these tax credits when there are quarterly taxes.
Okay. And then this last bullet here, it also applies to individuals who did elect Cobra once they were terminated, but then discontinued it for whatever reason prior to April 1st, and who otherwise would still be eligible. So that means that say I lost my job 3 months ago, I got on Cobra within the 30-day window, and then for whatever reason, probably because I couldn't afford it, I discontinued coverage, but I still don't have insurance, so therefore I still qualify. I would not qualify if I have gotten another job and I'm on somebody else's group health plan, or if I'm on Medicare. So these last two bullets, I think we've got them right. I think determining who these AEIs are is the key to this whole situation. And if you're lucky enough to have a benefits administrator or a broker who can help you do that, and a lot of you have already heard from those people, what they've done, what they're doing is they're reaching out to their clients, asking them, what I've seen is they're asking them to fill out, they're showing them a list of potential employees who might be assistance eligible based on terminations over the last probably year or so. And they're asking you as the employer to confirm or deny that this person was involuntarily terminated or otherwise had a reduction of hours or otherwise qualifies for Cobra. That's the starting point, is my understanding. And then they would sort of they'll package that up. I'm not sure what happens after that because I haven't seen it, but I'm assuming they'll package up that final list of names, and then you would send that to us so that we can help you apply those tax credits. And we'll talk more about that in a second. So I have seen some of those go out to some of my clients. So if you have a firm that's doing that, this is what they're getting at here. They're trying to find out who these AEIs are, make sure everyone's on the same page so that you aren't trying to get tax credits for people who aren't eligible, because we don't want that, because then you might get in trouble with the IRS. But also they need to communicate. There's a certain time frame that these assistance eligible individuals need to be communicated with, because they might not understand what's going on, and that they can get health coverage for free basically until September 30th, or until they get another job and qualify for another group healthcare plan. So this is a really important slide. And we'll talk, for those of you who do not have coverage, or excuse me, who do not have a benefits administrator firm that's helping you with this, we'll talk in a minute about some options that we think you might have. Okay, we do have a couple questions. Let's see. Kathy says, what would be the effective date of the coverage? Would effective date of coverage be retroactive with retroactive premiums due? Tara?
I would say I read that question. I think that is something that, I don't know if you've seen it in anything you've read, Leslie. I think that is something we are still trying to wait and figure out exactly, so you were somebody that was terminated and you signed up for Cobra and you've been paying it all these months, do you get that money back? Do you, how does that work? I don't think, I have not personally seen or heard anything that clearly defines that. Have you, Leslie?
I think that I'm going to go out on a limb, which is dangerous territory, but I think if somebody was, so if I lost my job today on April 20th and elected for Cobra tomorrow, I don't think I would be eligible for retroactive to April 1st, but I could be wrong. But I think it might, if I lost my job 3 months ago and I'm still eligible as of April 1st, I think it might be retroactive. But the only thing that's making me say that, Tara, is because there's this May 31st deadline for all of these AEIs to be notified. And that's pretty far into this period of coverage. So I would think that they would be some AEIs would be like, hey, well, I'm just hearing about this. So can I get my premiums, retroactively paid for? But I'm not sure how that works in practice. So maybe I shouldn't go out on any limbs.
And I can see, again, I can ask kind of our contact at the Cobra provider that we work with and see if they have any guidance or any information on that quite yet. I can see and come back with information about that if they know yet.
Yeah. Well, we asked them last week and they didn't. So
yeah.
I think these firms are really scrambling to figure out what the rules are too, because I've read the legislation, but I've also read the DOL FAQs probably 10 times at this point, and I still have a lot of questions.
Yeah.
Catherine says, I understand that employees cannot be eligible for insurance elsewhere, correct? And that is correct, Catherine. And we'll go through that, I think, maybe on the next slide, but they cannot, they can't be eligible for coverage elsewhere. They need to participate. If they've gotten a new job, or if they're on a spouse's plan, then they need to go with that plan and participate with whatever the premium situation is there. So yeah, this next slide is someone who is not eligible to receive Cobra premium assistance, someone who is eligible for another group health coverage, such as through a new employer's plan or a spouse's plan, or if they're eligible for Medicare. Note that if a person has individual health insurance coverage, such as a plan through the health insurance marketplace or through Medicaid, they may be eligible for premium assistance. However, if you elect to enroll in Cobra continuation coverage with premium assistance, you will no longer be eligible for a premium tax credit, advance payments of the premium tax credit, or the health insurance tax credit for your health coverage during that period. So that's a note for folks who have gone ahead and gotten insurance through the marketplace or Medicaid. You can't, basically they're saying you can't double dip is what I'm reading that as. Let's see, and then Betty, hi Betty. If an employee was involuntarily terminated, but not for COVID-related reasons, are they still an assistance eligible individual? That's a great question. So I haven't seen anything that sort of draws a distinction between a COVID-19 directly related reason versus not. I do know that it can't be they can't just up and quit or be terminated for cause and qualify. It needs to be more of a layoff situation. So you'll see this note at the bottom: if the employee's termination of employment was for gross misconduct, the employee and any dependents would not qualify for Cobra continuation coverage or the premium assistance. But that doesn't answer your question, and I don't know. I've not read anything that says it has to be a COVID-related reason. I have just seen that it's anyone who has lost their job in the last year. I guess the assumption is that a majority of those folks, it was a COVID-related layoff. I don't know, Tara, if you have anything else to add to that one.
Yeah, when I was, again, talking to, the Cobra provider that we work with, they kind of drew the line as right now, their understanding of it is any involuntary termination, was part of it. So again, like you said, Leslie, if it was voluntary or gross misconduct or something like that, you were terminated for cause kind of thing, then no, you wouldn't be eligible. But if it was involuntary and it was, any other reason, they're not, from what I'm understanding, they're not making you say, hey, this person was specifically laid off because of the fact that of COVID. I don't think that they're asking that question. I guess that could change and more legislation could come down and they could maybe better define that. But right now it seems to be involuntary as long as it wasn't for for cause or, gross misconduct or something like that.
Well, Betty follows up saying all of our involuntary terminations during the time frame have been poor performance or not rising to the level of gross misconduct. I think that's tricky. I mean, I feel like if you're let go for not meeting company expectations, whether that's poor performance or stealing from the company till, I don't think you're eligible for Cobra, even in normal times. Is that right, Tara?
So that would be I think for the purposes of this, that the answer is going to be, no, that you're not going to be eligible for this Cobra continuation. But I don't know. That is a question that your Cobra provider could probably really help you out with. And they would be able to kind of talk you through those, because they're the ones that are managing, what those life events are. And, basically did that employee even get a Cobra notice when you terminated them originally? I mean, did they, for that qualifying event, did they get Cobra paperwork? That might be even the deciding factor, because not everybody gets Cobra paper. When you're terminated, not everybody gets offered Cobra. So that might be how they end up deciding, how it's who's eligible for this Cobra continuation.
She said, Betty says, yes, they did get paperwork.
Did. So they might be.
Yeah, I mean, I have to admit, Betty, that's a gray area, and we'll do some more research. But if they got paperwork, then they must, from a assuming that you're participating with a Cobra administrator, then I would work with your administrator to figure out where these people fall in the ARPA-ERA Cobra world, and if you can get in tax credit for them. Okay, yeah. So if you use iSolve benefits, you probably also got an email from them at some point asking you to take a look. So I would definitely respond to that email, see if those employees fall on the list that they're giving you, on that verification list, and then work with them to say, I just want to triple check. This person was let go for this reason. Can I still get the tax credit? And then if they say, if the iSolve benefit says yes, then I would go with that.
Yeah. And I just made a note to ask that as a follow-up question as well, Leslie. So I can get back about that question as well as the retroactive. I can see if we can get a little bit more guidance from, the Cobra provider that we work with, and see if we can, just maybe get, see if there's at least anything out there for you. It could be some of these questions are the same things that they're waiting for, questions to be answered. So.
Yeah, good point. And we do hope to get somebody from them, our friend Matt from iSolve Benefits, on one of our webinars in the coming weeks, so we can, put him on the spot.
Yeah.
I'm sure he wants answers too. So
yeah, Matt he works at iSolve Benefit Services, which is one of the, which is the Cobra provider that iSolve, the iSolve software system can kind of feed over to. And so they are the Cobra provider that we typically work with. And so I have called him up and just asked him for general guidance on a lot of this, and he's been very helpful, and said in a couple of weeks, he'd be happy to hop on one of these webinars and share as much information as they know. He basically was worried about coming today, because he said he just knows that there is so many gray areas out there. Still a lot of the questions that are coming up. I don't think it's just that we don't know them, Leslie. I think that in general, everybody's kind of wondering the same thing right now.
Yeah, well, good for him. I understand that. And I think that he's going to be, and I think they'll know more even in a week's time, maybe 2 weeks. Yeah. The process piece of it, I know a lot of you probably have questions on, and that's something too that we're, as always, looking to decipher and make more clear. How long does premium assistance last? It can last, like the longest it can last is from April 1st through September 30th. And again, I do think there's some retroactive potential here. We just need to figure out for whom. However, it will end earlier if an employee becomes eligible for another group health plan, such as if with a new employer or a spouse's employer. not including accepted benefits, QSEHRA or a health FSA, or they become eligible for Medicare, or they reach the end of their maximum Cobra continuation coverage period, which is generally 18 months from the day the employee was terminated or had a reduction in hours. So, you know, if it's truly a COVID era layoff that we're talking about, they might have been laid off a year ago, and in which case they still have another 6 months on that continuation coverage period. But the way that I'm reading this is that it doesn't necessarily have to be a COVID reason for layoff. And so they could have been laid off in the fall of 2019 and still be unemployed due to COVID and still be within that 18-month window for coverage. So you could get a tax credit for that person going all the way back. I mean, unless someone tells me otherwise, that's how I've read it. All right. Okay, so how long will be provided? It's AEIs do not have to pay any of the Cobra premium for the period of coverage from April 1st through September 30th. It's reimbursed directly to the employer, plan administrator, or insurance company through a Cobra premium assistance tax credit. Employers will obtain the subsidy through a payroll tax credit against their quarterly taxes. If the credit exceeds the amount of payroll taxes due, the credit will be refundable when employers submit Form 941, their quarterly tax return. The credit could also be advanced under rules that will be set by the Treasury Department, which I have not seen yet. So that's sort of a cryptic sentence there that I don't know if the DOL people were like, you know what, we're just going to lob this over to Treasury and see what they have to say. But I haven't seen, and I admit I haven't checked in the last couple hours to see if Treasury has updated things, but looks like the DOL has taken the lead on this. All right, how do you get the subsidy? So like we said, if you are working with a benefits administrator like iSolve Benefits, or even your plan, even your healthcare plan provider, to determine who on your team is eligible. And then, like I said, they may have already reached out to you. And then once those AEIs are determined, then they will send the required notices to the AEIs. And there are a couple notices that they need to see so they are aware of their rights. Once all that's determined, and if we figure out who's going to participate and who's not, then you need to let us know at customerservice@dominionpayroll.com, and we will apply the tax credits. If you don't have a Cobra administrative service, we can recommend one. And again, I'm not trying to sound salesy. It's a very reasonable service. It's reasonably priced. It integrates with iSolve. So if you're one of our clients, as soon as you terminate somebody for whatever reason, it's totally integrated with the Cobra administrative service. You don't have to send out any notifications. You don't have to worry about any of it. So that's kind of a nice thing. I believe it's $1 per employee per month to participate, and there's no contract. So if you're interested in that, let us know. But if you already have somebody who is administrating your Cobra notifications, they should be on top of it. If you haven't heard from them, I would go ahead and reach out to them. Anything else, Tara, that you can think of?
Yeah, no, I think that last slide kind of sums it up perfectly, because right now we are getting a lot of questions of like, hey, are you guys handling this for us? And it really does start with whoever your Cobra provider is. So whoever your Cobra provider, if they haven't reached out already, reach out to them, and they're going to be the ones mainly helping you to the best that they can at this point. I mean, again, and with iSolve Benefit Services, they have a thing. They're like, hey, this is who we think is going to be eligible, but they only are kind of letting you look at it and select. They aren't letting you actually submit those yet, because they're waiting for that, additional legislation to come down to make sure that this is the real list of possible employees that are terminated employees that would be eligible. And then once that part is kind of done with your Cobra provider, you can reach out to us with that tax credit information, and we handle it from there. So it really is kind of a two-part. First is your Cobra provider, and then it's us. So yeah.
There's never just an easy one-part process during these things.
Wow.
But that's the thing. Like, that's typically that would be the easiest way to go about it. If you administer your own Cobra paperwork and you want to go this alone, I would read over the 2 documents that I posted in the chat and use those as your guide, and then monitor the DOL's website for additional guidance, or maybe Treasury. But at the same time, you will need, if you do this by yourself, you'll need to sort of self-determine who is eligible, who the assistance eligible individuals are on your staff or formerly on your staff. So you'll need to maybe, and I think you have until May 31st to let them know that they're eligible. So you have a little bit of time to figure that out. Okay. Nothing is easy in the COVID era. Well, Tara, I appreciate you and all of your assistance today as we continue to learn more about this provision of the ARP. And
I'm happy to be here. And like I said, I will circle back and ask see if I can find out anything extra on that, about retroactive. And then if you were terminated for, involuntarily, but it wasn't for any COVID reason, just trying to find out more information about both of those things, and we'll pass that along.
Okay. Yeah, we can probably put something on the DominionPayroll.com's COVID-19 resources page. We'll definitely post this presentation there as we normally do, but we can, if we find out more about these assistance eligible individuals and the criteria, we can post that there as well. Let's just check on this one question here. Let's see. Pamela says, does anyone track if the assistance eligible person takes Cobra as a result of this, or is the tax credit automatic?
I think you just get the tax credit if that Cobra assistance eligible person enrolls. So like if you offer it to 10 different people, maybe 8 of them have already got a new group health plan, through a new employer or through their spouse or something like that. Remember, those people are no longer eligible. So yeah, I definitely think you have to track who actually signs up. And then that is how you know how much your tax credit is.
Yeah, and that form, that second link that I posted in the chat, is designed to sort of keep all of that information in one spot. Whether you, like, if they apply for it, and then if you deny it or confirm it. And now Tara and I think that form really only is to be used by companies that are administering their own Cobra.
Yeah.
We think that if you have a Cobra, a third-party administrator, that they're going to take care of all that, and they'll have a mechanism to track all of that. But again, you want to give them a call and see if you can get some answers about their particular process.
Yeah, I mean, I keep going back to ISO Benefit Services just because they are the ones that I talk to the most and work with. And I know that right now they have at this point sent out 3 different emails talking about, hey, this is, what we know about it, for the most part. And then kind of giving you like, this is what you should be doing right now. Like, these are the steps you should be following, which is looking at this list of, employees and, going through it and whatever, and then they will send out all of the paperwork to the assistance eligible individuals, and they will handle all of that and handle I believe they'll handle everything, even as it return comes back, they will handle all of it, and then they're the ones that will actually be able to tell they're basically going to give their clients a piece of paper. It sounds so easy, but it's something like that, where they'll say, hey, you have 5, so you get this many, this many tax credits, from this whole program. So from what I understand, Cobra providers are pretty full service, when it comes to this.
Yeah, so if you're interested, if you don't have an admin service right now and you're sort of like panicking about this, it might be worth your time and money to sign up, especially there's no contract. You could just have them, you could sign on for 6 months and cover this and make sure that you don't have to worry about it, sending out those notices, because there's always a certain time frame that you have to send them out by, and then you have to track down the individual. So it could be worth your time and treasure for the interim. And then if you like it and want to keep on with it, then you can do that. All right, again, not a sales presentation, but I do want to make sure you guys know how to help yourselves here and this make your lives a little bit easier. Oh, Kathy Clark says, I Solve Benefit Services gets 4 stars from me. Well, that's good. See?
Hey. Kathy, have you seen some of those emails coming through? I mean, I hope you've probably seen some of them, and hopefully they've been kind of helpful.
Yeah, and I've seen other ones too from some of my other clients who are not with benefits I saw, but with other types of third parties. She says, yes, we've been asked to start our list of AEIs.
Great. That's great.
So awesome. Thank you, Kathy. We always love real world anecdotes from you guys. So please let us know what's working and what's not. All right, Tara, we thank you so much for your time.
I appreciate it.
And we'll probably have you on here again sometime soon.
Yay. Well, thanks. I appreciate it. You have a great day.
All right, you too.
Bye.
All right. For those of you in Virginia, I thought I'd mention the Virginia Overtime Wage Act, yet another acronym, VOIWA. I don't even know how to pronounce that one. It essentially changes the way we calculate overtime in this state as of July 1st. So until now, Virginia employees have relied on the FLSA to govern their overtime pay claims. That's the federal law. Similar to the FLSA, VOIWA requires that all non-exempt employees receive time and a half for hours worked more than 40 hours in a work week. So that's all should all sound familiar. However, Virginia will now be departing from the FLSA in 3 ways that could increase your liability, including changing the calculation of the regular rate of pay for non-exempt salaried employees. We'll go through that in detail in a second. Then giving employees 3 years to bring lawsuits from the date of the violation, regardless of whether the violation was willful. So the difference there is that the FLSA, the federal law, gives employees and employers an out if the violation was not willful, it wasn't intended. If you didn't know you were doing it, if you can show good faith effort to correct the problem, there's a sort of a backdoor there. Virginia no longer allows you to have that option. Also extends that period to bring lawsuits from, I believe, 2 to 3 years. And then the third one is Virginia is now omitting the good faith defenses for employers and providing for potential triple damages and interest. So if you're in Virginia, now more than ever, it's time to analyze your overtime compensation, who is eligible, and how you calculate that rate. Okay, so the first change, the regular rate of pay calculation. Now, under the FLSA, non-exempt employees are to be paid 1.5 times their regular rate of pay for hours worked more than 40 hours in a work week. Under the FLSA, employers calculate an employee's regular rate as follows. Their total weekly compensation divided by the total hours worked in the work week is the regular rate of pay. This is the same calculation for all non-exempt employees, whether they're paid on an hourly, salary, or other basis. And again, this is what the law of the land has been. And here's what it's going to change to. As of July 1st, Virginia employers must calculate a non-exempt employee's regular rate of pay as follows, but only if that employee is paid on a salary basis. So we're not talking about hourly employees here, we're talking about non-exempt salaried folks. So non-exempt means they're still eligible for overtime, but you are paying them on a salary basis. So an agreed upon weekly or biweekly amount, annualized to a certain amount, that's a salary basis. But they're still eligible for overtime because they don't either they don't meet the exemption salary threshold, which is around $35,000 a year, or they might meet that threshold, but they don't meet the there's sort of a duties test for employees who, in order for them to be classified as exempt from overtime, they have to have a certain amount of autonomy, decision-making, managerial level responsibilities. If you have any questions about that, I'm happy to answer those too, because that's a whole nother kind of discussion. But in any case, a non-exempt employee who's paid on a salary basis, they would have their total weekly compensation. So say that's $1,000 a week divided by 40 hours, not the number of hours that they actually work that week, but 40 hours. That would equal their regular rate of pay. So regardless of how many hours they actually work that week, the calculation would always be divided by 40. And then again, if they're hourly, then you would default back to the regular FLSA calculation described in the previous slide, which is divide their weekly compensation by the actual number of hours worked. I hope that makes some sense. Well, let's do some math. Okay, so under the FLSA, which has been, again, the standard in Virginia, a salaried employee that makes $1,000 per week and worked 50 hours that week would have a regular rate of pay of $20 per hour, which is $1,000 divided by 50. Thus, all overtime should be paid to that employee at $30 an hour, which is 1.5 times $20. So you'll see here, I've got their weekly compensation, which is $1,000 divided by 50 because they worked 50 hours that week, making their regular rate of pay $20. To determine the overtime rate, that would be 20 times 1.5, which is 30. So their straight time earnings for those 40 hours would be $1,000, which is their regular weekly compensation, and then they earn $300 in overtime, which is that $30 an hour times 10 extra hours, making their total earnings for that week at $1,300. In Virginia, as of July 1st, the same person would be dividing that $1,000 a week by 40, regardless of how many hours they actually work that week. That brings their regular rate of pay up to 25. It also brings their overtime hourly rate to $37.50. So their straight time earnings again would be $1,000, and then their overtime earnings would be $375 as opposed to $300 like on the previous slide, with their total earnings bumped up to $1,375. So $75 in once or twice here and there is not a lot, but if you have a lot of people that would fall into this category of non-exempt salaried, this could add up pretty quickly. So let's go on. I see your question, Emily. I'm going to answer that in just a second. Okay, let me go back. Okay. So Emily says, if we work a 37.5 hour work week, do we still use 40 hours? My understanding, Emily, is that yes, that is still the rule at the state level, state and federal level. But that's something I need to actually double check, because, and I don't know how you do it now, Emily, if you pay overtime for someone who works over 37.5 or if you wait until 40. But all that I've seen in terms of this new act in Virginia is the 40-hour threshold, but I will double check. Let me just make a note here. Okay, so that's how it changes the regular rate of pay calculation, which is, again, can be pretty significant if you have a lot of people who fall into this category. If you have 1 or 2 people and you can sort of monitor their hours, then it probably won't be too big of an impact on your bottom line, but you'll have to see how that works out and for your particular situation. The other 2 bullets that other 2 changes that I mentioned earlier, the second one here is statute of limitations. Again, the FLSA, those suits must be filed within 2 years or within 3 years if the employee can prove that the violation was, quote, willful. In Virginia, as of July 1st, all employees have 3 years to file suit, regardless of whether or not the violation was, quote, willful. And the employees could potentially recover back wages for that 3-year period. So that could be a blow financially. That could add up very quickly. And then on top of that, the VOIA has also provides for the recovery of lost wages plus liquidated damages. That's similar to FSLA or FLSA, sorry, but has no good faith exception for employers. So even if you didn't know what you didn't realize you were doing something wrong, you have less protection now. If you did realize you were doing it and the court determines that that the violation was, quote, knowing, then the employer may have to pay, then you might have to pay triple damages. The law also requires the employer to pay pre-judgment interest at the rate of 8% from the date that wages were due, and if found liable, the employee's reasonable attorney's fees and costs. The law also allows employees to bring their cases as class action or collective actions, which Typically, it's not the case in Virginia, but this law has gone that extra mile. So not to be scary, but this is where we stand in Virginia as of July 1st. Stephanie says, if we have shift workers like physician's assistants in an ER who work shifts varying from 8 to 12 hours and are paid a base salary of $4,000 per month, and then a premium of the difference, $65 an hour, times the number of total hours worked per month, 4,000 equals premium. How would we look at the calculation as of July 1st? PAs are not specifically exempt from FLSA rules like physicians, so that is why we pay a base salary above the limit to not have to pay overtime. That's a great question, Stephanie. So there are some people, there's some certain types of jobs that are exempt from the exemption rules. There's special rules, teachers, healthcare providers, salespeople. Now might be a good time to go back and refresh your knowledge of the FLSA so that you just to make sure that all of your staff classifications are compliant. I think, Stephanie, that I'm going to have to look into your particular situation a bit more closely. If you don't mind, can you just copy and paste this into an email and send it to questions@dominionpayroll.com? And then we'll see if you need to make any changes or not. We still have some work to do on our end to figure out how this works. And like, we're gonna have to make some system changes so the math is correct on our end too. So I don't know the actual answer to your question at this time. I'm sorry about that. All right, I'll make the notes. All right. So that's moving on from Voya. Okay, Stephanie says, we know for a fact that PAs and nurse practitioners are not directly exempted from the rules. We looked at this with a lawyer 4 years ago when we came up with paying them a salary. Thanks, I'll send it. Okay, good. Well, sounds like you're doing due diligence. I'll see what I can find out on this end if you want to send that to questions@dominionpayroll.com. All right, we're going to shift gears again to our old friend, the employee retention credit. Tracy, are you still with us? Have I bored you to death?
I am still with you. I was sort of kind of waffling because it's like 9 minutes to 12. So I was like, oh, I don't know. I mean, I can go over it. I'll go quickly.
Well, we'll end with the ERC, and then like I said, you guys, the deck continues into PPP and FCRA.
Okay. I don't know how quick we'll be with employee retention credit. We'll do it our best.
Okay.
All right. So there are 3 acts that affect the ERC. So we had the CARES Act at first, and that was the one that said you could have 50% of the qualified wages paid to an employee plus the cost to provide health benefits to the employee. And that depended on what level of threshold you were as far as how many employees you had. So that was a full-time employees of 100 or less, you could get all the wages would be qualified. And if you had over 100 full-time employees, then it was just the wages that you paid while they weren't working, for instance, like a paid furlough. The CAA became effective January 1, 2021. And what that did was to increase the credit amount to 70% of the qualified wages, including that healthcare benefits. And then that extended it out to the end of June. And then ARPA came along and went ahead and retained the 70% credit and increased the time period to go to the end of the year. All right, so the eligibility. So the eligibility didn't change too much between all of the acts, but basically what it was is that for CARES, you had to be a business that was either fully or partially suspended by a COVID-19 lockdown order. So think about like restaurants or gyms or dentist offices or any place that had to shut down or partially suspend their business. So if you're not back up to 100%, you would still be qualified. But back then, we're talking about 2020, you would have looked at the time period that you were affected by that governmental order. So for instance, like restaurants, like I just said, they were affected, I think it started March 25th of 2020 and has gone all the way until present day. So they're still qualifying under that. The other qualifier, and you don't have to have both, you just have to have one, is that for any quarter in 2020, if you had gross receipts that are less than 50% of gross receipts for the same quarter in 2019, that qualified you for the credit. To unqualify for the credit based on gross receipts, you have to actually be within 20% of your gross receipts for the same quarter in 2019. So you qualified for one quarter with that 50% down, but you don't unqualify until you're at least 20% or less down. The CAA came back and said, okay, that's going to start on January 1st of 2021. And they're also going to do the fully or partially suspended. But for the gross receipts, it is going to be 20% or more. And the way they did it was they said you could either qualify with the quarter that we were in. So let's say first quarter, you would look at first quarter 2021 as compared to first quarter of 2019, or you could look at fourth quarter of 2020 as compared to fourth quarter of 2019. So those were the two ways that you could qualify based on gross receipts effective January 1st, or you could also qualify with that complete or partial shutdown. ARPA did the same thing. They just extended those same rules that the CAA had to go through the end of the year. So it's the same amount for the drop in decline in gross receipts and also that partial shutdown or full shutdown. All right, the maximum credit amount. So CARES Act, and that's the one that kind of calls the shots for 2020, capped the credit at $5,000 for all qualified wages paid between March 13th, March 13th, 2020 and December 31st, 2020. So it basically was a credit amount allowed for $10,000 in qualified wages, and you multiplied that by 50%. The CAA came back and said, okay, well, we're going to increase the credit rate at cap, and that's going to be $7,000. So it's basically 70% up to 70,000. Excuse me, I'm going crazy. It's basically 70% up to $7,000, and that's per quarter, which is significantly more because prior to this, it was $5,000 for each employee up to the whole time period. You could just get to $5,000. And the CAA said you can get it per quarter. So, and ARPA extended that to the end of the year. So basically you could get $28,000 for a employee that was compensated at, $40,000 or $10,000 each quarter, $40,000 annually. You could get up to $28,000 back, which is pretty significant. Okay, so this is what I alluded to just a minute ago, is the credit eligibility, whether or not an employee is working. So the threshold was 100 full-time employees in 2019. So you have to go back and look at your 2019. They're trying to figure out for pre-pandemic amounts. Now, if you weren't a business that was in business during 2019, the CAA actually allows you to use 2020, but when they do a full-time employee, they are considering that somebody who works 30 hours or more. And that is not an FTE. A lot of people get confused and say, okay, well, let me just figure out how many FTEs I have. That's not what they're asking, because they're not going to take two part-time employees and put them together and make one. They are looking for how many employees do you have that work 30 hours or more per week. So if you have a lot of part-time people, they don't actually count in your full-time employee count. Their wages do count. You get to use those wages as part of your credits, but they don't count in that full-time employee count. So CARES Act 2020, it's all about 100 as the threshold for the full-time employees. Once the CAA took effect, which was January 1st, they increased that threshold amount to 500 full-time employees. And that's just saying that ARPA also continued that 500 employee threshold. It also talks a little bit about the severely distressed industries. So if you fall into that category, I'd go ahead and read through this. Not right now, though. Okay. The Paycheck Protection Program, I'll just go over this super quick. So basically what they had said originally was like, well, if you have a PPP fund, you cannot have the ERC. And then on December 27th, when the CAA came into effect, they rescinded all of that, and they said, oh, well, actually you can get it. So you can take wages that you did not apply to the PPP funds in 2020 and apply them to the ERC in 2020. You will have to file an amended 941. We do that for you if you are one of our clients. It is a service that we have available, and you can reach out to us through questions@dominionpayroll.com if you're not already participating in that and want some more information about it. The CAA again said that you could use the wages, or you can use the wages in 2020 or 2021 that are not being allocated toward PPP funds. So that's kind of what they all say now. So as long as they weren't allocated to PPP, you can apply them to ERC. If you're eligible, you have to you have to vet yourself. And if you reach out to us, we're going to give you the criteria for, do you fall under this decline in gross receipts? Do you fall under this full or partial shutdown? So you'll have to analyze your own situation to decide whether or not you're eligible.
And Tracy, just as a process note, if you're one of our clients and you'd like to participate in the ERTC, you can go to our website, the COVID-19 page, and fill out that survey. That would be step one, correct?
Right. And they're also there right above the survey is an overview. So if you're like, gosh, this is a whole lot of information, and it is, there's an overview there that kind of goes through the same process. But yes, you would fill out the survey, and that kind of gets the ball rolling for us.
Okay. And then we have a question from Anonymous that says, will you have a refresher PPP forgiveness calculation webinar?
Yes, we will. Our report has just come out for 2021. I'm not sure if you're asking for PPP forgiveness 2020 or 2021, but they're basically the same. The reports are a little bit different because there are a couple of different things that you get under 2021 that you didn't get under 2020. It's probably, if you need some answers on that, go ahead and send them to questions@dominionpayroll.com and I can look at those. Usually I'm taking them on a step-by-step basis now for the PPP 1 and PPP 2.
And just a reminder that the deadline to apply for a PPP loan has been extended from March 31st to May 31st.
Yep.
Law extends authorization of loans to June 30th to give the SBA additional time to process applications.
Yep. And our new report is out. We do have to have a loan disbursement date to put in our system so that the report will populate. And it does give you a place to put in your end date, because now you have a choice of either you can decide when you want to end your covered period between 8 and 24 weeks. It has to be longer than 8 and less than 24, or 8 to 24 weeks. So it's fairly straightforward. I've seen 2 glitches in the report, but they have not been widespread to all clients. Like, I've only seen it on 2 different clients, one glitch on one of them, one on the other one. So hopefully that's going to get resolved soon, because we did send those tickets into iSolved.
Great. Thank you, Tracy. Well, we're past 12 o'clock, so I'm not going to dive into the FFCRA, which is another like 10 slides, but we will post this. This might be the most comprehensive PowerPoint
Oh my goodness.
done. But we will post this on our website on the COVID-19 resources page by the close of business today, so you can have all this. I do encourage you, if you have not educated yourself about the ARPA-ERA FFCRA paid leaves, go ahead and do so. It's something that's a great benefit for you and your employee if they get sick or want to go get vaccinated. You can get tax credits for that time. So we're still in this pandemic, guys, so don't forget that you could have somebody be sick or be exposed, or they want to go get a vaccine, you can realize tax credits for all of that. So with that, I want to thank you, Tracy, again, and Tara and Kevin, and we will sign off. Well, except though, Kevin, if you're still with us, do you want to promote tomorrow's webinar real quick?
Yeah, absolutely. Great webinar today, guys. Ton of information in there. So tomorrow I'm hosting the Beacon, our sort of ongoing sort of industry spotlight series. We're going to be looking at sort of the business funding environment, talking about PPP loans. What does bank lending look like? What are some of the alternative programs presented by the SBA? And really just sort of how are folks managing the sort of transition period from being shut down to reopening. I'm really excited to have Brian Kirkpatrick. He is the Director of Finance for the Vail Brewery. Jennifer Mitchell is joining us from Old Point National Bank. And Hamuda Shami is the owner of Don't Look Back restaurant. So not only will we have sort of a philosophical conversation about, what the funding environment looks like, but also a boots on the ground, like how are folks operating their business and navigating these things. So that's tomorrow at 11. You can go to dominionpayroll.com and register for that webinar and all of our upcoming webinars.
Great. Thanks, everybody. We will see you tomorrow at 11 o'clock.
Have a good day, everybody.
Bye.